This is Economic Choices, Section B lecture. Our prioritized standard is Economic Standard 2, and objectively, we're going to investigate how labor productivity can be improved through specialization, division of labor, and investments in capital goods.
Now, there are actually three factors of production, or productive resources, which are all the resources required to produce the goods or services consumers want to buy and producers want to produce. Meaning, anytime you buy a product, even something like a crop, there are different types of resources that are actually converging and coming together to actually produce that crop. Most crops just are not ready for consumer automatically. So, of these factors of production, one of these factors of production is land, or natural resources, which are the gifts of nature that are present without human intervention. So, like, these are the things that God says, hey man, I got this. So the things that would be around even if humans weren't here tomorrow. So stuff like land, timber, fish, oil deposits, mineral deposits, the fertility of soil, the climatic conditions of an area, all the things that are just always here, and they are here regardless of humans being here. Another factor of production is labor, or human resources. So this is the quantity meaning the number of something, and the quality, or how good something is, of human effort that's directed toward producing goods and services, which can be improved through investments in education, training, and healthcare. So whenever humans decide to do some type of work, that is considered labor. Now there's kind of a subset of labor that is considered entrepreneurship, which are human resources that assume the risk of organizing other resources to produce goods and services. So when people are using entrepreneurship, this actually means that entrepreneurs are going to risk economic failure in return for the possibility of earning a profit. So another way of thinking of entrepreneurship is labor, people have an idea, and that idea is entrepreneurship. So this person might have maybe grown peaches previously, but then they actually made the decision that, hey, maybe I can use these factors of production in a way that's different than it's been used in the past. And by doing that, I can get my peaches faster than I normally got my peaches. What's profit, Mr. Booth? Good question. Profit, this is when total revenues exceed total cost. So if this were a college course, we'd be throwing out this equation. So your total revenues minus your total cost. Total cost, this just means all of your fixed costs plus all of your variable cost. Add those together, that's your total cost. Total revenue, well, funny you mention that. Total revenue, how you calculate that is you take the selling price of an item, or P, multiplied by the quantity of the item sold, or Q. So P times Q will give you your total revenue. So generally speaking, if you're generating more money through sales, price times quantity, than it costs you to produce a product, it actually means you've actually generated a profit. If you did this equation and you got a negative number, it actually means you've lost money. And the last factor of production is capital, sometimes called capital goods, which are the goods or services used to make other goods or services, meaning someone already produced whatever this product was. And based on producing that product, it's now being used to produce something new. So for instance, I'm actually using technology to produce this lecture video, but it doesn't mean that I actually invented technology. Somebody else invented technology. I'm just using that technology to make the lecture video. Maybe mom makes peanut butter jelly sandwiches. That doesn't mean that mom invented peanut butter. I'm guessing she also didn't invent jelly, and she probably also didn't invent bread. Someone else invented all those things, produced those things, and mom's just putting those things together to actually make peanut butter jelly sandwiches. So productivity is the amount of output, meaning goods or services, that are produced per unit of input or productive resource used. So in a sense, you could say how much you produce per person. That could be productivity. So increasing productivity means producing more with the same amount of resources, or producing actually the same amount with less resources. So let's say they give you like a ream of paper and you make a paper airplane. So if they give you a same size ream of paper and you can produce more paper airplanes, that means you have actually increased your productivity. Now, productivity is important to businesses because it can lead to both greater incomes and profits. So the more productive a business's workers are, the more product they can make, which means the more money they can make. Also, productivity is important to workers because it makes them wealthier. Now, just being productive doesn't translate to you just magically have more money in your bank account, but usually people that are more productive are going to get more business opportunities. When there are overtime hours being offered, they usually offer those to the more productive workers. When job promotions are being given, they usually give those promotions to people that are considered more productive. So the more productive you are, that's usually not just good for your business you work for, but also usually for the person. The higher the productivity a country has, the higher the living standards for its citizens. To aid businesses in maximizing productivity, business owners actually use a process known as marginal analysis to measure the additional benefits of one production activity versus its cost to determine optimal levels of production. Now, determining marginal analysis actually requires a business to calculate profit at various points. So when increasing production results in any decline in profit, a business will not produce at that level. So when they do the marginal analysis, it will tell them different points of, hey, we make profit at these points, but once we hit this magic point, we actually start making a loss. So generally speaking, once businesses determine what that break-even point is, they will never produce at any point other than a point that actually generates a profit. Many methods can help improve labor productivity. Now, labor productivity can be increased through specialization and also through the division of labor. But both of these strategies actually tend to reduce self-sufficiency and actually increase economic interdependence. So, for instance, one term, specialization. This is when people produce a narrower range of goods or services than they consume. So, potentially, you might have lots of skills, but you might decide that I'm going to specialize in what I do. So instead of knowing how to make several different types of products, you actually are specializing in producing just one product. This is, in a lot of ways, the basis for trade and exchange in a market economy. So lots of things you could be doing, but you decide I'm going to focus on one thing and just do that one thing, even though there might be other things that I might have the capabilities to do. Now, division of labor. This is the process where workers perform only a few steps of a major production task. So commonly when people talk about division of labor, they think of the assembly line, which is certainly a type of division of labor. So essentially, instead of knowing how to produce a car, because previous to the assembly line, people actually produce cars by themselves individually. But they actually determined that we could produce more cars if everyone just specialized on one part of making the car. And by doing just one part of it and dividing up that labor, then we can produce cars at a much faster rate and therefore also do it more efficiently and therefore cheaper. So that's division of labor. In a sense, division of labor is kind of like specialization, but you have specialized in what you've specialized in. So, hey, I'm making cars, but I'm not actually making all the cars. I'm just, I put the steering column in or whatever part you have specialized in. Investment in capital goods and human capital also increases productivity. Investment in capital goods occurs when labor is provided with additional up-to-date tools and machines. So in a sense, it makes it easier to increase production. So maybe you invest in a new machine, and based on producing that new machine, you can produce more product than you could have previously produced with an older machine. Investment in human capital occurs when labor receives additional education and or training. So possibly maybe you decide to go to a training seminar, maybe you decide to go to college, maybe you decide to go to some type of certification program, whatever it is you decide to do. The logic is you're spending less time actually doing what you might do to make a living, but they are giving you skills so that when you do decide to go back to work, that you'll be able to produce more product than you previously did.
Additionally, one can increase productivity with technology, which is the incorporation into production of new knowledge and processes. Now, technology tends to be the leading cause of long-run increases in productivity. Technology relies heavily on incentives to reward innovation and also on investments in capital goods and in research and development, sometimes just called R&D.
So, as basic as the Apple II might seem now, it actually was very revolutionary because it actually increased the abilities of different businesses to produce at a much faster rate. Now, such investments, not just this, but all the ones we talked about, can have significant opportunity cost and economic risk. These cause actually reduced productivity in the present in exchange for expected higher productivity in the future. So if we go back to this example, we're talking about investment in human capital. So we are assuming that by taking part in this training, we're going to be better workers after we have this training. But in the meantime, you're not producing anything. When you're at a training meeting, you are doing nothing. Nothing is being produced. And you're hoping that by doing that, you'll actually produce more when you do start producing again. Now, expected increases in productivity are not actually guaranteed. So you might expect to make more money as you get more education, but that's not always guaranteed. You might invest in new capital, and that new capital might quickly become obsolete. So just because you expect to increase productivity doesn't always translate to you do increase productivity. So government actions and policies play a role in productivity and can actually harm productivity if laws and regulations are in fact too restrictive.
All right, this concludes Economic Choices Section B lecture. Our prioritized standard is Economic Standard 2 again, and objectively now you can investigate how labor productivity can be improved through specialization, division of labor, and investments in capital goods.